this morning, up $1 or so. And let's bring in our regular Monday morning commentator, Omar Najia, Global Head of Derivatives at BV Energy. Omar, good morning. Good to see you. Another Monday, another bounce.
Another Monday, another bounce. People will say, it's Biden and the stimulus that's responsible. And I would say basically the market was already heading higher, but this will basically cement the rise. It's very interesting. The other thing that's interesting is, of course, Iran, gave the finger to, the US and Europe. And the reason
which finger is that exactly?
Yeah, exactly. The middle one. And it's quite funny because people were saying, no, they're going to talk and we're going to see and whatever. And what Iran has escalation dominance, which means the US can do absolutely nothing and Iran can do absolutely anything it wants with very plausible deniability. So you saw over the weekend an Israeli merchant ship blow up. And that was after the US did the Biden striking of Syria for freedom and all that kind of stuff. And what's interesting is that, that kind of reply, the US can't deal with. It's either basically the US has to go into a full-blown war, or there's not much that they can do. Iran can hit vessels, Iran can hit Saudi, can hit oil installations, Iran can hit, US troops in Iraq. Iran can do so many things. The US and its allies
what does it mean for the oil markets, that point? Ultimately, it seems that these events, as you describe them, the US attacked Iranian allies in Syria. The next day or so, there was a ship in the Sea of Oman that was hit, and yet it didn't seem to disturb the oil price too much.
No, again, I don't think basically the point is that for the oil price to be disturbed, you've got to have like a binary outcome, war, okay? For the moment, that's unlikely. But if things stay as they are, if the US, the Biden administration doesn't actually understand that it cannot push Iran around for concessions, it can't play diplomatic games, it can't play military games, it just has to basically go back into the agreement, lift all sanctions, maybe pay reparations. And if they do that, then everything will be okay. But if they don't, then I think after the next 3 months, tensions will start to rise. Tensions are good for oil prices. Wars, of course, are very sad, but even better. But I don't think there's going to be a war. But, the Biden administration is on a steep learning curve. They need to learn very, very quickly. Otherwise, this is going to go a little bit pear-shaped, I think. So the risk for oil basically is to the upside. It's not that, they meet and everybody does nice and Europe says, we'll be able to do and brothers and, that kind of stuff. It's all about action, either lift sanctions or we're going to a very, different kind of outcome in place. So let's see what happens.
Let's welcome in Adi Imsirovic, a senior research fellow at the Oxford Institute of Energy Studies. Welcome back, Adi, to the table. Despite the liftoff this morning, we're more or less back to where we were because the markets did come off quite strongly at the end of last week, and for fairly profound reasons that might come back. Your thoughts, Adi, this Monday morning?
I think the market's actually been relatively fundamental. I wouldn't disagree with Omar about the market being tight and strong. And I think last time when I was on your webcast, I pointed out to very good, strong demand. Let's revisit some fundamentals that have been happening and why we got where we have. We're pretty much almost at levels, pre-COVID levels. And the reasons were very, very fast, rapid stock draws that we saw, especially in the Q4 last year. There were well over 3 million barrels a day. Floating storage is gone. It's not there anymore, pretty much. We've drawn in OECD, where we have good data. We've actually drawn a lot of oil, probably up to 200 million barrels of storage. So demand's been it's been very, very good. China has grown in Q4 last year. China grew at, I think, 6.5%. That's a lot for the whole of year. In spite of COVID, China grew almost 2.5% last year. So, you know, we just Chinese storage filled last year about 400 million barrels of oil. That's a lot of oil. So the fundamentals are there. That's why we are where we are. How far we're going to go further obviously depends on further demand. We can increase refining capacity. I mean, we have refining capacity. We can utilize another 5 million barrels of that, and it's very likely to happen this year. So, you know, demand side has been a lot stronger than most people anticipated. I usually say we had Libya came in, and that was a very good indicator. Libya came in from nowhere, gave us well over 1 million barrels of oil, and nothing happened, right? I mean, you know, market accommodated that very, very quickly. So obviously there was a lot of pent-up demand.
Well, what did happen, I don't know if 1 and 1 is 2 or not, but very soon afterwards, Saudi Arabia made a unilateral cut of 1 million barrels a day.
That was a very, very good move by the Saudis. You know, Saudi Minister Abdul Aziz said, expect the unexpected. I think it's a very good strategic move. First of all, they stamped their saying, look, yeah, we are the leader. And secondly, what they did, that they wanted markets to start guessing. When the markets don't like guessing. So whenever the markets have to guess, it's usually the upside. So I think it was very.
That's
very
what Omar does every day. He makes a fortune. Let's bring in our other commentator this morning, Daniel Richards, senior economist at Emirates MBD. Daniel, despite the positive commentary there by Adi regarding China, Emirates MBD this morning in your daily note pointed out that China's growth momentum slowed in February, with both the manufacturing and non-manufacturing PMIs easing. Was your top comment in your daily note today? Maybe some outlook of concern there in China.
I think it's likely just a passing thing, to be honest. Obviously, there was a slowdown in those PMI surveys, both in the official one and the occasion one as well, and both for manufacturing and services. But you have to think about that included for the New Year holiday, and also there were some restrictions brought in, as we saw a brief flare up in some cases around China, and we know from last year when this happens, they are very rigorous and strict in implementing lockdowns, and this will have an impact on the economy as a whole. And they've shown in the past they will do that, and they will continue doing that, I'd imagine, if we see flare-ups. But that being said, I think the danger is largely passing. Although, I mean, if there is a further flare-up, what we've seen about reluctance to take vaccines in China might be a further risk there. But by and large, I think February slowdown was probably something that will be ironed out, and the outlook for the year is, for quite substantial growth. As was mentioned, growth last year, one of very few countries globally to secure real GDP growth around 2.5%, and that's even despite being the epicenter of a pandemic. And looking ahead is likely to be one of the growth outperformances this year as well. So a slowdown in February, but probably passing issues, I'd say.
I also noted in your comment today that petrol prices in the UAE will rise by a whopping 11.7% this in March. We're now March 1st today. This is a trend we're seeing all over the world, of course. Riots in Brazil and India, other places. How much does that, do you think, challenge, let's just say, the fragile economic recovery around the world in 2021, this sort of rising price at the pump, if you want, the retail level of energy?
Yeah, of course. I mean, it differs from country to country, as you'd expect, given the different elasticity of spending on the back of these things and how much it impacts as a proportional level to household incomes. But as you mentioned, in Brazil, we've already seen unrest there. And UAE is probably not going to make that big an impact, given that price growth has largely been negative on the back of what we've seen in rental market generally, which has been a deflationary pressure. But there is a risk that it could impact around the world, if not by giving rise to instability, as we've seen, even just on impacting household incomes. And the outlook for India is quite positive this year again, but again, as oil prices rise there, we could see another rise in inflation as we saw last year, which could kind of slow that growth we'd expect in consumption levels there.
Omar, the other sort of news out this morning in Asia with the recovering oil price this morning, we also have the risk currencies, if you like, of Asia all having an upward move against the dollar. The dollar remains sort of tacked on the floor. How does that play into your outlook?
Well, I think basically the dollar, the dollar index is trading somewhere around 91% now. The low set on January 6 is 89.2. So either that is the low, or basically there is one more low to come. The point being that if from where we are right now, call it 91%, if we manage to take out something around 91.6%, then that low is cemented and off we go to the upside. And, dollar weakness is done and dusted, and everybody says why and how, and let's find a story why we can explain it. If the dollar does go down and take out that low at 89.20 on the dollar index, all that'll mean basically is that that low is going to be the low from which the market rises. The market is extremely, and has been for a long time, short US dollar against GBP, against the euro. You look at gold, all that kind of stuff. Gold is the first one to start to kind of wobble, and wobble seriously. So we've come off from about 2000 and something to 1700, and I think we get down to 1615 and below 1000. I'm not a believer in this, inflationary stuff, because I don't believe that the Fed prints anything. Nor does it, print stuff and go and hands it out to people. It's more to do with debt. Although the checks, basically, these $1,400 checks, blah, 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 that'll take care of anything to do with, not wanting to spend on gasoline because it's up a little bit. So again, I think oil demand is healthy. Vaccines are here. COVID levels have dropped like 80% since January. We still have the vaccine blip to go. I'm positive. US dollar, I think either it strengthens remarkably from here, or one more new low. And I don't believe in any correlation that says, oil prices can go up, oil prices go down if the dollar goes up. You've seen it various times, quite recently. So let's see what happens, but I'm bullish the US dollar.
Adi, big week for OPEC in the coming days, and as we move through the week, I'm sure the noise will start vibrating a bit. What's your own outlook? I mean, for not what you think they will do, but what do you think they should do? What does the market point towards for a Q2 supply strategy?
Well, first of all, I think they should congratulate themselves when they meet, because since the last meeting, the oil price gone up $10. So that's certainly something to celebrate. I think the strategy of meeting monthly has been a very good one. And I think that's given the OPEC Plus this flexibility where they can actually literally listen to what the market is doing and adjust accordingly. Obviously, the market needs more oil. As we said this morning, there's a lot of pent-up demand. As Omar just said, the vaccines are here, the economies are growing. Japan manufacturing activity expanded this morning. The news were, at the fastest pace for 2 years. India is looking good, as Daniel mentioned. So everything is looking fine. So they should supply an additional volume. The only issue is, again, if you're sitting at the trading desk, is what Abdulaziz said, expect unexpected. And that's exactly what they want to do. They want the market to keep guessing and keep worrying. Normally, you would expect OPEC to come out. Well, first of all, expect Saudis to come back with that million that they did voluntary cut. and possibly with another 1.5 million barrels of additional pre-agreed oil. The only problem is that, as you said, Sean, we're going into Q2 when actually there are refinery turnarounds in Asia. So we'll have a lot of refinery capacity getting offline, and that the demand is likely to be a lot softer. We've seen actually the strong bit. We've seen the pre-Chinese New Year buying, and also a lot of that buying came from independent refiners or teapots. They're very price sensitive. So the oil that we saw delivered was all bought around $50. At these levels, I don't think they're going to rush to stock up and buy too much oil. So it's a very difficult one for OPEC. I think it will be very, very tricky. I think they should do a lot of analyses and see how the sort of balances pan out before they make any decision. But it will be a tough one.
I mean, you were quite complimentary earlier in your commentary that Saudi made a very sensible decision. Obviously, it delivered in January. Is it the sensible thing to do to continue with that through April?
I think it would be. That the problem is obviously, I think in one of your news lines this morning, you had Saudis extending potentially a loan. They need the money as well. They are the leader, but at the same time, they have actually taken the brunt of all these adjustments. So it's not going to be easy. And time after time, the Saudis have expressed it very, very clearly that they are not going to be the swing producer. So they will put pressure on everyone else to keep in line. And the fact that they cut that million was actually a sign of their leadership, a sign of their voluntary sort of I don't think they'll be there to do it time after time.
Okay. Yeah. The speed in which they might withdraw it then is up for question. Daniel, another comment in your daily Emirates MBD note today, which is another emerging trend. While we're debating inflation, Omar thinks it's nothing to worry about. Others might think it is. It's certainly making the headlines regardless. The other thing, of course, is how are we going to pay for all of this stimulus? And you've put in your note today the situation in Britain, because the British Finance Minister Rishi Sunak is going to put his budget in place this week, and he has already warned of the enormous strains in the country's finances from the very generous stimulus. What's your outlook on that as countries emerge from the forest of generosity and have to start looking how they're going to pay for this stuff? What's its impact? How will the market, do you think, absorb that?
Yeah, it'll be really interesting to see what actually comes out of the UK budget this week. Obviously, Sunak has kind of been flag posting, potentially tightening, or that he'll warn of further tightening at the very least, given what he's been talking about with a rise in yields and how 1 percentage point rise in yields across the board would lead to £25 billion, I think it was, extra debt servicing every year. He was doing the rounds on the Sunday political shows yesterday talking about this. So really starting to flag post that they will be looking to rein in spending. And that's, this is a Conservative government. They're a self-declared party of fiscal responsibility, especially this particular one. The authors of Britannia Unchanged and all the rest, Unchained rather, and all the rest of it. They are generally against higher taxes, but given this higher public debt level, I think it's risen to over 100% of GDP around the midpoint of last year, levels not seen since 1962 or so. And as we've seen these higher yields start to come in, that will be a concern. So governments will be looking to at least make the right noises on this, but at the same time, they can't risk damaging the recovery by taking away support too early. And while we are seeing improvement in vaccine rollouts, etc. In the US, we had very strong retail sales data. We've had for private consumption rise 2.4% in January as well. That was on the back of the checks on the higher support. And given that the labour market everywhere remains fairly weak and businesses have pressures ongoing, we'll be looking out for non-farm payroll numbers on Thursday, or Friday rather. But last month, I think we were only 49,000. Initial jobless claims are still around 4 times what they were before the pandemic every week. So it's a delicate balancing act for governments. I think for the time being, what they'll be doing is talking about, we are aware of this, we've got it in hand, and we are prepared to take action when it's necessary. But all the same, I don't expect any stringent kind of tax hikes or taking away the support just yet.
But perhaps the first pointing towards what might be coming, higher corporate tax rates, for example. And maybe that's one reason why we're seeing property prices rise in Dubai at the moment, as people start to look to the future of higher taxation in Europe. And so that Dubai story once again comes back to being one to think about. Let's go to the survey question for the outlook of the coming days regarding Saudi Arabia. What do you expect Saudi Arabia to announce regarding its unilateral cut of 1 million barrels per day that expires on March 31st? What do you expect Saudi, not what they should do, but what do you expect them to do? Saudi will keep the cut in place for an extra month for April. Saudi will end the cut sharply on April 1st and open the floodgates. And 3, Saudi will phase out the cut over 3 months in Q2. What is the view of the room on that? And let's go around the table looking for the days ahead. Omar, we've seen this movie before, so to speak. The markets open on Monday morning strong, as they did last week, ended the week a little bit weaker last week. Of course, this week we have an OPEC meeting between now and Friday. How do you think this coming trading week will play out?
I think basically markets are in a long-term uptrend. I think corrections happen along the way. So I don't think anything strange about oil falling or the S&P coming off. It's healthy.
But we still haven't seen that correction that you had articulated a few weeks ago. Do you think it's still there? That it's still possible that we could see that?
Yeah, I think definitely it's still possible that we'll see that. What you do with markets is you say the most probable outcome is this one. The less probable outcome is this one. Doesn't mean it doesn't happen, just means right now, looking at the market, it's less probable. So yes, it could happen from here. It could happen from 4,600 on the S&P. Similarly for oil, it could happen from here on WTI, could happen from 65 on WTI, could happen from 76 on WTI. Right now, it's more probable on WTI, for example, that we get to 65 and then correct. On the S&P, it's more probable that we set new highs, take out 4,000, and maybe then correct. But yeah, I think basically what you've got to remember is uptrend. It's pointless trying to pick like a top and all this kind of stuff. Are you bearish? Are you bullish? If you're bullish, the market's in an uptrend. If it dips, you buy it. But you don't pick levels at which you want to sell and go against the market and all this kind of stuff.
But typically, you have as a technical a proponent of technical, you see points of resistance, drops. I mean, it is quite a technical call where you see those numbers hit and where they fall to rather than sentiment. I'm just wondering, are there any technical calls where we could see that correction come?
On WTI, sure. So on WTI, market's trading, whatever, call it 63 right now. So if we manage to take out something along the lines of 60.50, you can get a tiny bit aggressive and say, okay, the top is in. If we take out something like 59.50, you could actually be like, yeah. And if we can break 59.50, maybe get to 58.50, something like that, then you can really have confidence that, yeah, we're headed, we're correcting, blah, blah, blah. And the market is basically going to go lower correctively. And on the upside, if you get past the 63.81 high, the next target is 65.65. If you take that high out, there's not much until you get to about $76. So the question is, and the OPEC thing about expect the unexpected and all this kind of stuff, it makes nice stories and all the rest of it, but let's see what happens. And OPEC will be not very bright if they kill the golden goose, so to speak. They need money.
His warnings, the prince's warnings, have always been about the short sellers rather than the long, it seems. And I don't think he has to worry too much about them at the moment. Daniel, the fiscal health of Saudi and others clearly remains under some duress, even at these elevated prices. Budget deficits are still quite significant. Where do you think that would guide us to read the tea leaves a bit on where Saudi wants to go to keep the price elevated and so perhaps keep this 1 million barrels off the market for a little longer, rather than gain market share, gain a higher price would serve them better?
Yeah, I think that does seem to have been their priority recently, and even at the 57 or so Brent's average to date, that's still somewhat lower than the 75 or so they need for a break-even budget. So there's still some way to go on that. And while they're cutting spending, I think budget expenditure is going to be cut by 7% this year. Obviously, there's some PIF stuff aside from that, but they are looking to rein that in. And on the other flip side of the less spending, they'll want to get more income as well. So I think maintaining price is especially important as they look to make their decision this week.
Okay, let's get the survey result before giving Adi the last word this morning. Saudi to phase out the cut over 3 months in Q2. But still 25%, as Omar says, the probability, and then there's the possibility. And still 25% of the room think that Saudi could keep this cut in place for an extra month. Adi, of course, is going to tell us what is going to happen because he has the crystal ball. Adi, your thoughts on that and the outlook for the week?
A crystal ball is saying that Saudis will use that million as a lever in this meeting, I think. So what's going to happen is very, very hard to tell, because obviously it's a matter of for the negotiation with all the other OPEC Plus members. But certainly they're going to use that as a lever and say, okay, we can probably extend this, but what are you going to do? Make sure that you stick to agreements and whatever. So that's
there's a suggestion in the chat room that Saudi will look to others to take up the million.
Absolutely, the Saudis don't want to be a swing producer, but they certainly would want something from the others before they make any further sacrifices. So I just think they're going to use that as a lever. And
do the others includes Russia? Do you think? I mean,
absolutely.
they seem to be quite generous to Russia on the last meeting.
Absolutely, and that was. I mean, almost a gift last time, but also it was a way of saying, look, we are the leader. We want to lead this plus alliance, and this is how we do it. We'll lead from the front. But this time around,
do you think the recent difficulties, let's just say, without getting too down the rabbit hole, that Saudi is currently having with its friend in the Washington could weaken its position vis-a-vis Russia at this point?
Well, that's a very good question. I haven't thought about it. It certainly could push the Saudis probably even closer in an alliance, an OPEC Plus alliance being actually a very good conduit for such a political development. It's just early days at the moment.
Yeah.
I think everyone is trying to find these red lines at the moment with the new administration in the US, and what Omar started talking about Iran. I think what we are seeing right now is not situation getting worse into a conflict. I think everyone is just looking for these new red lines, who is where, before they start serious negotiation.
Yeah, I think that might be another thing to keep an eye out on this week is, will we see more little moments like we saw in the Gulf of Oman, where some container ships were hit, as a reminder, as we saw 18 months ago or so. These things never just came in ones. They usually came in threes and fours. So the possibility of more might be one to keep an eye out on the market for that development. We just promoting our Global Energy Outlook 2021 was just published and should have made its way to your inbox. If it hasn't, it's posted on the social media sites and perhaps worth a look at when you have a few moments on the weekend or elsewhere. Thank you, everybody. Thank you, Daniel. Thank you, Omar. Thank you, Adi, for your insights and for your commentary. I hope everybody has a safe day and an economically productive week, and we'll catch up with you in the coming days. Thank you.